Hello, it's Victoria Scholar here, and welcome to IG's Trading the Markets podcast. A $2 trillion economic stimulus plan has been agreed by US lawmakers this week. It's the biggest congressional bailout in US history as Republicans and Democrats join forces to combat the economic and social fallout from the coronavirus. Joining me on the podcast today is Nick Cawley, market analyst for Daily FX. Nice to speak to you, Nick. Sadly, you can't be face-to-face as normal in these rather surreal times, but thanks for joining us from home.
No problem at all.
So I wonder if you could just talk us through some of the key parts of the agreement that we know so far.
Yeah, sure. As you said, this is a unprecedented sort of $2 trillion agreement. But basically what it is, it's yet another sort of stimulus measure to boost the US economy. The US economy, as in all global economies in Q2 and Q3, are meant to all slide heavily into sort of recession. But this package does is it provides direct support for small and large companies throughout the US who have basically been hit by the coronavirus and the effects to their businesses. And it also provides sort of measures for these companies to sort of keep their employees or furlough them, I think they call it, in the US, so that even if they have to put them on sort of standby, that the employees still get paid. It's, as I said, it's an unprecedented package. I think we also have seen coming up in the US, we're going to get a sort of helicopter drop where families up to a sort of certain wage bracket will get like a $1,200 check or payment made directly to them. So I think what this package is doing, which is sort of different from the monetary policy that we've seen of late, is providing money at the ground level where it's most needed at the moment.
So do you think that's what the economy needs right now then, this major stimulus program?
Very much so, yes. I mean, there's no doubt about it. The economic havoc wreaked by coronavirus is again unprecedented. Is words that we'll carry on using, I think, in the next few weeks. And whereas your traditional money stimulus, like cutting interest rates, or even sort of slightly offbeat monetary stimulus by using QE, they're a more sort of top-down sort of monetary flow, which will take longer to sort of go through, trickle down to the sort of the grassroots of the economy. These sort of fiscal measures that we're seeing at the moment, they are basically money in your pocket, or your tax codes will be cut, or you'll be having relief holidays, tax holidays on for up to 3 months. So it's basically putting money directly at the grassroots levels of the economy.
There has been this sort of discussion about monetary versus fiscal policy for quite a long time, really, ever since the last financial crisis in 2008-09. We know there was this massive wash of monetary stimulus, and that's essentially been part of what's been stimulating markets and the economies for over 10 years. Mm-hmm. In this instance, the problems that we're facing now are very different. So do you think that monetary policy has kind of run its course?
Yes, to a certain extent, I do. I think its effectiveness, as I said, of going down the line, the sort of trickling down into the economy, it is slowing. I don't think it is as effective as it was before when Mario Draghi made his famous "whatever it takes" speech. So yes, I do. I mean, it's still necessary. It's still necessary to boost the economy at the top line. But what you really need, especially with the speed that this virus is spreading and the effects that it's having in the economy, you need money right at the bottom in people's pockets. So that's the only way that the economy can get a boost. It improves sort of sentiment. It makes people don't feel too worried about where they are, their financial position, because they know basically the government's got their back.
So, I mean, in terms of President Trump, it seems as though we've seen a bit of a U-turn from him recently, at least in terms of his economic policy response to COVID. I mean, he tweeted, we've got to make sure that the cure isn't worse than the problem. And he's since said that he's hoping that the economy will be reopened by Easter. I mean, is that a realistic time frame, do you think?
I'm no expert on the spread of the virus, but I would say it's very unlikely. I mean, Donald Trump is first and foremost, he says something, tweets something, and then a few days later there's a reversal on it. Or one of his lawmakers or sort of cabinet members, what do I want to call them, will come out and actually sort of qualify what was said. I don't see how the US can reopen or business as normal and after the Easter holiday, which I believe is around 12th of April, something like that. I don't see how in 3 weeks they're going to turn this round now.
Yeah, okay. So in terms of the markets, obviously we saw this huge surge in US equities this week. It was just ahead of the stimulus. The Dow had its best day since 1933, rallying by 11%. Don't know about you, but I've started to become a bit numb to these big headlines. I mean, the volatility in the past month, for me at least, is something I've never seen before. So kind of before we get into the direction of the markets from here, I just wanted to get your thoughts on the overall volatility. I mean, for traders, do you think this creates opportunities, or does it just make life a bit harder?
I think it makes life harder. I mean, I've seen the 87 crash, I've seen the 2008 crash, and I've sort of seen these sort of conditions before. But these, as I said, the volatility that we're seeing at the moment is exceptional. I mean, traders, if you're trading a currency pair, sterling versus the US dollar, you need a certain amount of volatility, day-to-day volatility, so you can get in and get out of markets. You know, you can enter and exit markets. You need a trading range, you need a band that you can get into. I think what happens when you have the volatility at the extremes that we are at the moment, it makes it very difficult to really pinpoint where you should enter a market and where you should put a stop loss on the market. If you're putting a stop loss too tight, as you normally would do during normal volatility levels, you're likely to get taken out because the swings are so wild. So, I mean, what we've been sort of saying to people that we chat to is that one way of looking at it, or we've been talking amongst this with all the other analysts and in daily FX, is one way of looking at it is maybe what you can do is you can trim back your size that you normally trade in. So, for example, if you're normally trading £10 a point, just as a number, on a currency pair, maybe trim that back down to £5 a point and let yourself have that ability to just have a slightly wider stop loss. So you'll then, if we still have this volatile market, you'll have a better chance of staying in your position and benefiting from it. I mean, I don't think it's definitely not a market to make big bets or up your trading size at all. I think you should really be downsizing on your trading sizes, keeping in the market, finding out about price action, and hopefully still benefiting.
Yeah, that's the thing, because you can have the right idea, but it's so easy to get stopped out in these markets. But in terms of the actual direction from here, kind of what are your thoughts? I mean, we've obviously seen this relief rally after the Fed with its generous open-ended asset purchases, and now the congressional stimulus on top of that. I mean, do you see price action going higher from here, or is there a risk that we're falling into a bear trap?
Very good question. I think...
And if you knew the answer, you'd be...
If I knew the answer, I'd be a very wealthy person. No, I think what we have to understand here is that the actions by the central banks and governments globally are for one thing and one thing only, and that's to shore up this market straight off the bat. I can't see markets really going too much further lower here, because all that'll do, if we have another big sell-off, that will just prompt some more monetary largesse. I think we're getting to a stage where, personally, and as I said, this is just my view, I would find it difficult, or I would be really questioning myself if I was trying to be an aggressive short at these levels. I think that would be difficult to really justify. I don't think markets are going to jump spectacularly higher. I think you may see a slow grind higher, up a few percent, down a couple of percent, and so on. But I think overall that the amount of money that has been thrown at the markets, and as I said, in such a short term as well, once this really starts moving through, this $2 trillion package by the US, when you use the multiplier effect, it's meant to be worth about $4 trillion to the economy. Wow. So, I mean, you can see that there's just so many noughts being thrown at this market that I do think there comes a stage where being aggressively short, at least, is becoming very dangerous.
All right, that's all we have time for today. Thank you so much to my guest, Nick Cawley, market analyst at Daily FX.
Thank you for having me on the show, Victoria.
I'm Victoria Scholar, and thanks for listening to IG's Trading the Markets podcast. We'll be back next week, and don't forget to subscribe.